I now hand the conference over to Ms. Radhika Piramal, Executive Vice Chairman, VIP Industries Limited. Thank you, and over to you, madam.
Thank you so much. Good evening, everybody, and thank you for joining this call. The results would have been shared with you just recently in the last 30 minutes. I do hope you've had a chance to look at it, or you could have a look at it right now. Sort of to be expected, the revenues are nowhere in line with our hopes. COVID has affected us badly. We have had excellent plans for the current year. Regretfully, the second wave has put a dampener on the current quarter. One good news is that we have in place an excellent professional management team leading our company. And in our last call about 3 months ago, I mentioned Mr. Anindya Datta would not be speaking too much on that call. This time, I'm very pleased to say he's fully inducted into our company, having joined us on the 1st of February, and he will be leading this call for the rest of the duration of the call, including the Q&A. Alongside him will be Ms. Neetu, our CFO. So over to you, Anindya. Thank you.
Good evening, everyone. Thank you for taking time out and joining this call. We will talk about the Q4 results to begin with, but before that, let me put a little context. We know that the pandemic has hit an industry, a luggage industry, possibly the worst or the hardest way. In the Q4, we started seeing easing of the pandemic environment in terms of more free movements. Travel came back to about 70-75% level of the same time previous year. In line with that, our Q4 revenues were at, as you would see, at 243 crores from operations, which is at 78% revival compared to the same period previous year. Similar revival metrics was 54% in Q3, 25% in Q2, and a mere 7% in Q1. The 78% revival, however, as a caveat, the previous year March was already hit by the pandemic and therefore was at a suboptimal level. So we saw all lead indicators like travel, people moving out, all easing out and coming back. However, the luggage industry continued to have some headwinds, which I would like to call out here. Schools and colleges remained closed and continue to obviously do so. International travel did not resume in Q4. One of our largest accounts, Big Bazaar, continued to operate at a suboptimal level compared to the rest of the modern trade, largely owing to the Reliance Big Bazaar merger takeover. In addition to all this, we witnessed also a surge in raw material prices, which is quite unprecedented. The polycarbonate ABS prices were almost 2.3 times to 2.5 times of pre-COVID levels. So the headwinds were not only on the demand side but also on our margins. Despite our margin for Q4 was at 47%, gross margin I'm talking about, while sequentially it is better than the previous quarter of 40%. However, it continued to be significantly lower than the same period last year. The corrections in the discount and the mix correction were partially offset by increase in the input cost. In terms of the fixed cost, the overall fixed cost for the quarter was 103 crores compared to 146 crores of the previous year. While it was sequentially higher than Q3, largely due to the reinstatement of salary reductions and expense on travel and office, which resumed. However, the structural cost reduction to the tune of 80 to 90 crore at annualized level has sustained and will continue to do so. At PBT level, we have a loss of 5.7 crores against a loss of 8 crore in Q3 and a profit of 10.4 crore in the Q4 of last year. For the full year 2020-21, the numbers, as you would have seen, are as follows. Total revenue at 667 crores, 39% of previous year. Gross margin at 45% against 53% of last year. Fixed cost at 318 crores as against 614 of the previous year. At this stage, I would like you to know that out of the reduction in fixed cost, other than the advertising, sales, promotion and freight expense, the saving is almost 171 crore, and almost 80-85 crore of this is sustained in the coming year. With all this, we had a loss of 124.6 crore as against profit of 148.4 crore at a PBT level in the previous year. It's quite evident the impact of the pandemic on luggage industry and our company has been very harsh. However, I just want to highlight that while we were in this crisis period, we had the company had worked on strengthening its fundamentals. Today, our Bangladesh manufacturing operation has significantly scaled up, and going forward with the Bangladesh manufacturing strength and India consolidation, we'll have a far better upstream control, and also we will have long-term advantage on cost. We spoke about structural cost reductions, and those fixed cost reductions has made us significantly leaner going forward. We are also working on revamping our supply chain structure, which not only will make us far more responsive to the volatility in the demand, but it will also be at a lower cost. We have also ensured that our distribution and our reach has sustained through the crisis and pandemic, and we witnessed our distribution almost scaled up to the similar levels as previous year in March and April in terms of the number of doors that we sell to. And lastly, I think we strengthened ourselves in e-commerce, where we were possibly competitively under-leveraged in the past, and this we did with a lot of augmenting of the portfolio, addressed the gaps that were there in our portfolio, corrected our supply chain, and also worked on improving the productivity of our ad spends. With all this, we started very well in April. In fact, the first 3 weeks of April was very encouraging because we saw things really coming back to almost pre-COVID levels, run rates. And unfortunately, after that, the pandemic hit again, and this time much, much harder. The impact on the business is similar to last year's complete lockdown. We, however, feel the recovery this time will be over a shorter duration, and hopefully with lockdowns gaining control on numbers and vaccination scaling up, we should start seeing faster recovery. I just want to end by saying that we feel quite optimistic in the long term. VIP Industries is all about products to do with joy, celebration, moments in families, travel, vacations, marriages, fashion, etc. These cannot remain subdued forever, and situation will become normal hopefully now sooner than later. It's very difficult to predict the duration, but as we come out of this, the demand is bound to get back to its original trajectory, and we will come out stronger. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and 1. The first question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity and hope the team is keeping well and safe. First question is on demand scenario. So it's been more than a year since we would have experienced normalcy in demand. And however, last 4 months, Jan to April, is something which can be referred as closest to normalcy in some form, obviously not the full normalcy. So if you can share some insights on consumer behavior, where they're more discount seeking because gross margins have improved sequentially, and is there any fundamental change in how consumers are traveling and how they are looking at the whole category post pandemic, or now we have in between pandemic now again? So first question pertains to that.
Thank you, Tejas. So as we are experiencing now with is just when things came out of pandemic around Jan to April, I think the post-impact of pandemic was still there in terms of consumer behavior. The travels were possibly not as much, and a lot of safety was their concern. So while this had an impact on the quantum of the demand, but in terms of nature of the demand, I don't think there will be much of a distortion as things comes back completely to its normal. It is just the impact of COVID and the concern around safety and security is possibly governing some bit of choice. Like people are buying more hard luggage than soft luggage right now. But I don't personally see impact which is long term.
Sure. Second question pertains to margins. Obviously, inflationary scenario has worsened YOY across across raw material baskets, and for our commodities also, underlying commodities, there's a sharp inflation, and we already had a gross margin shrinkage last year YOY. So keeping all these factors in mind, how would you like to play the whole pricing power of ours in terms of branding power that we have in the year ahead? And how should we think about gross margin and EBITDA margin, assuming that normalcy comes back by the second half of this year?
That will be a big assumption in terms of what kind of normalcy comes back. But I would assume that even after the best case scenario, it will not exactly be the same as what it used to be before within this financial year. So there is going to be a constrained demand, and it will have its impact on margins because the pricing is going to be always a challenge in terms of from a competitive pressure point of view. However, as I was saying, that fundamentally I think VIP has done everything that is the right thing to do in terms of making our portfolio, our cost the right, and therefore as demand situation becomes exactly normal as it was before, our margin should be back to the same levels that what we used to be and even better.
Fine. And lastly, if you can comment on the insurance proceedings, any update on that?
So Tejas, I'll take this. So on insurance proceedings, we are still, I would say, 3 to 4 months away from getting a clear picture. It's a PSU, and because of the second lockdown, again, the people are not there now. So we are very positive, but yes, it will still take 3 to 4.
Sure. That's all from my side. Thanks and all the best.
Thank you. The next question is from the line of Amandeep Singh from Ambit Capital. Please go ahead.
Thanks for the opportunity. Firstly, we note that the global luggage players are still closing EPOs to keep the cost under control amid COVID-led uncertainty. So similarly, with COVID second wave impacting the recovery, can you help us with your thoughts if you would maintain your current EPO counts or might have a relook on the strategy and close few more stores? Also, any update on the rental waivers across the malls and high streets amid the lockdown again?
Right. Thank you for the question. You're right. EBO is a concern on cost, but VIP we had kind of taken hard measures in the previous wave itself and had kind of shut down almost 100 stores. As we speak right now, our viewpoint is that we would like to continue most of them. We can still look at a few which is falling, which is almost sitting on the fence in terms of its long-term potential to profit. But this is something that, as we speak right now, we are wanting to continue with these reviews. It is also based on our assumption that we think this time the turnaround will be faster or quicker than last time.
So, sir, and any update on the waivers which you might be discussing because it's again a lockdown?
Yeah, so we've started the conversation. It's very recent right now. It's been last few weeks when this has happened. But that's something that we'll obviously put up very aggressively with the landlords and look at any possibility of waivers and reduction in rents in the short term.
Thanks for that. And so secondly, on the employee cost, now with the second wave of lockdown, will it be fair to assume that the run rate will remain at same at rupees 38 crores per quarter going forward, or will it be fair to expect more efficiencies here?
At this stage, we are, we've done a huge amount of cut in the previous year, and I think our approach would be to continue with the team and the morale and keep ourselves ready for growth going forward. And therefore, we may have some bit of efficiency happening here, but largely we will continue with the employee base and the talent that we have.
So, sir.
Just to add, the employee cost for the quarter does not have incentives and other things. If we do well, then that will be the additional cost.
Noted. Thanks. And we have been also hearing that the supply chain issues with respect to sourcing from China have sustained. So in that context, can you help us understand if VIP is also facing similar supply chain issues even now?
As I was saying, that we have moved and successfully moved a large part of our production to our in-house production in Bangladesh. So going forward, any kind of exposure to China supply chain issues is something that we will possibly not have. Though we are dependent on some raw material coming from China, and there is implication on freight rates that have increased significantly between China and Bangladesh. But in terms of a larger disruption because of what may happen in the China trade, it's not something that we will be impacted with.
Yes, sir. And so finally, I mean, if we were to just extend the previous question, and now with you on board having the experience in the international markets in the past, is it fair to assume that VIP would boost its export sales via OEM manufacturing, assuming that even other luggage players globally would be facing similar supply chain issues from China, or is it too early to say that?
Strategically and in the long term, what you're saying is yes, that's something that we would be eyeing. But as we speak, as an immediate short-term measure, that's not something that we may land up with or choose to do. So, but that's something that is under evaluation. It will be a better time possibly in the next discussion to see where we land ourselves on this.
Sir, thank you and all the very best.
Thank you.
Thank you. The next question is from the line of Jinesh Joshi from Prabhudas Lilladher Private Limited. Please go ahead.
Thanks for the opportunity. If possible, I just need one small clarification. Now, if I look at our gross margins during FY21, in 3 out of 4 quarters, we were lower than one of our listed peers. Now, I know that there is some bit of cost inflation and discounting is also going on. But, sir, in the past, such cases have been rare when our gross margin is actually lower than the other listed peers. So, is there anything specific that you would want to highlight?
I think that's owing largely to the discounts that we were running, and our pricing was significantly higher compared to most in the market in terms of the mid-range that we had, and therefore the discounts on that were higher. But as I said, that as demand started coming back and we had taken control of the total inventory situation, as we moved the discounts out from what we were running, we will come back to our, we'll come close to our original levels of gross margin.
Sure. And secondly, given that there is cost inflation which is prevailing currently, is there any action on price front? Have we taken any hike recently, or is there something on the cards in the near future?
So yes, we have taken a price increase. In fact, two rounds of price increase, not very large, but as the input prices increased and was increasing, we took one in March and one now in April as well. So there has been, and this is not across the board, but this is more in selected range. Wherever we felt that we could take the price up is where we have taken. It has not resulted into a large part of the gross margin increase. I think the gross margin increase is largely owing to the reduction in discount and the change in mix. But as we open up and everything resumes, I think the higher price will start playing its role.
Sir, possible to quantify the quantum, the hikes which we have taken?
Would be difficult because it is not across the board one, so it's kind of by range in that. So it will be difficult for us to give you one number for that.
Okay, sir. Thanks a lot.
Thank you. The next question is from the line of Saurabh from HDFC Mutual Fund. Please go ahead.
Good evening, sir. Thanks for taking the question. Just wanted to, in the opening comments you mentioned about the savings in cost. Just wanted some more detailed thoughts on that, as in how much of these will be variable? Because when we see as a percentage revenue, our revenue has also fallen sharply this year. And as a percentage of revenue, many of these, the other costs especially, seems to be in line. So, and adjusting for, and if we adjust for the A&P, which we would be increasing as the demand improves, how much there would be a cost saving when, assuming the revenue is back to pre-COVID levels? That was one. And secondly, also international business, you talk about the OEM part, but any thoughts on creating a global brand over a longer term? Because our brand is very, there are not many large global brands. So is there an opportunity there? Your thoughts on that, sir?
Sure. I'll take the second question. Neetu, can you talk about the cost reduction part?
Yes. So on the cost piece, what we are talking about, the saving is on the fixed cost, which does not go in line with revenue. So that overall saving is around 171 crore, and 50% of that we said is sustainable going forward. Other than that, if you see, freight will go in line with revenue. And advertisement anyways, as and when the things improve, we will start to spend.
And can you just throw more like what would these costs be? I understand one would be employee cost, which you had been highlighting in the previous quarters also.
Yes.
Apart from
employee costs, there were two parts. One was a salary cut, which was there till December for 9 months. And then there was headcount reduction. So salary cut has been resumed from January, so it's back to normal. Whereas the headcount reduction remains. So that's how 50% of the employee cost saving will come back. And on the other expenses, 100 store closures, then we also had, so wherever there was rent reductions and waivers will come back. Whereas we, for example, we closed 100 stores now, that's a permanent fix. So like that. We have closed some of the offices. So closures, yes, it's a permanent, whereas wherever there was a waiver or a reduction, it is going to be.
But ma'am, just asking one thing, when we say this headcount reduction in store closure, so these will be permanent. But assuming the sales are back to like 600, 700 crores level, so will we be able to manage with these lower number of stores as well as lower headcount?
At this point of time, yes. On the management piece, we don't intend to increase the headcount.
Okay, ma'am.
Yeah. To answer the other question that you had about international, obviously we would love to take the strength that we have in India to the markets outside, and we will get to that. But before that, I think it's very important right now as we come out of the pandemic is to consolidate and get ourselves fully back up and running the way the India market was, and therefore our first focus as we are coming out of this would be to consolidate and to strengthen the core. Core is our domestic business, and that will be the first focus. As we do that, and depending on timing, we will look at how can we take our brand and our business outside, and at that point of time, possibly we can talk more in detail once we are on the start of that journey.
Sure. Thanks a lot for your explanation. All the best.
Thank you.
Thank you. The next question is from the line of Dhaval Dama from Motilal Oswal Asset Management. Please go ahead.
Hi. Thanks for the opportunity. So just wanted to ask you now, basically if I have to look at FY21 as compared to FY20, gross margins have been significantly lower as compared to our pre-COVID levels. And we are mentioning that discounting has been quite higher during the current year. But can you highlight or can you just give us some broader understanding, like say, if the product mix or the brand mix would have been dramatically different in FY21 for you as compared to what it would have been in FY20 or FY19? Just a broader understanding. Because to our mind, it becomes very difficult when we compare a value-based player or the third largest player in the category today making similar gross margins as what you have done during the current quarter also.
Right. So, yes, the product mix did change in FY21 in favor of the value portfolio within the VIP portfolio as compared to FY20. And that happened largely because that part of the market possibly was growing faster. E-commerce was something that was throughputing harder than most of the other channels, and we also played aggressively within those channels to get the revenue. So it did temporarily reduce or change the mix in favor of the value portfolio, but that's not how the VIP portfolio strength is, and therefore the VIP and Skybag and the ranges under these brands is something that didn't play its role as much in the revival phase because we were carrying stocks and we had to convert. When we started making in Bangladesh, we started making more of these lower end products because that's what the demand was. So I would keep it as more about a temporary phase where we had to go in with our value range more aggressively. But going forward, once the revival is there and we come back, the demand comes back to its levels of pre-COVID, we should be able to spring back to what our mix was before. A large part of that, if not entirely.
Sure. And second thing, one more thing I wanted to ask you now, given the current scenario, if I have to look at the company in terms of two buckets of how things can pan out over the next 6 months and over the next 3 years, if I have to say that. Now, do you think that, how long do you think that, as per your view sitting in today, this value portfolio will continue to grow faster? Like you mentioned in your opening remarks that April 1st, 2 to 3 weeks, there was a decent recovery and we were almost back to pre-COVID levels. So maybe if you can throw some light on that, basically how are we looking at over the next 6 months and over the next 2 to 3 years, and also would we be willing to sacrifice a lot of gross margins as compared to what we were doing at pre-COVID levels for market share gains? How do we look at it?
So to answer the first question, while the environment of constrained demand situation is there is always going to be a higher play of the value segment that will remain because people are going to compete on prices, and that will bring down the prices, and also possibly somewhere affordability kicks in during this time, and people, whatever purchase is happening, is looking at a lower price option. But that's short term. That's as much as what the current situation will last, and that's something that is very difficult to predict. But when you talk about the long term, I don't see the consumer behavior to be one only going towards the value segment or a large part going there. And also, the marketeers and especially our role in making the mid and the upper end is going to start kicking in, and that's what we would like to do to create demand at the upper end through innovation, through better products, through communication, and a better experience of the consumer. So that is what we were good at, and we'll continue to come back to do, and therefore I don't see that as a problem in the long run. Did that answer your question? You had one more question at the end.
Yeah. So basically, over a longer period of time, would you be willing to sacrifice some bit of your older levels of gross margins for market share gains?
So we were not. We will not be okay, losing market share. That's I think is a stronger result, and we would like to make sure that we gain back market share. And if that needs us to relook at our portfolio and to look at some bit of shaving of gross margin, we may do that. But right now, I think that's not something that is that's something that is an easy conclusion that to gain market share you may need to lose margin. But to answer your question, we're going to be strongly focused on gaining back our share.
That's it from my side.
Thank you. Participants who wishes to ask a question may press star and one now. The next question is from the line of Bhargav from Kotak. Please go ahead.
Yeah, good evening, team. My first question is on the preparedness to meet the pent-up demand whenever it happens, especially given that the window for pent-up demand could be as short as 2 to 3 months. So if we go by luggage companies' performance in the West, they have seen a significant growth since the population started getting vaccinated. So how prepared are we to sort of meet the similar nature of pent-up demand as and when it happens?
So I think we are pretty well prepared, depending on how and when that demand comes. As I said, we rely more of our own manufacturing, where we have a good amount of headroom to scale up, and we will be able to do that when things start looking up for sure.
Okay, so even if the window is short, we'll be able to sort of manage our supply chain to meet that demand. Is that assessment correct?
Yes, depending on how short the window we're talking about, but production, the lead time to production and hitting the market is always lower than the lead time to identify a sourcing and import it into the country. So to that extent, yes, but yes, there are a lot of assumptions here, and we'll have to see what is the lead time and when does that happen.
Secondly, is it fair to say that the Bangladesh sourcing advantage could be to the extent of 15%, given that imports from Bangladesh do not have any anti-dumping duty? So, given that our dependence from Bangladesh could now be close to 100%, it makes sense to sort of become aggressive in our journey to gain a market share. And given such a big cost advantage, is it fair to say that we may not have to sort of compromise a lot in terms of our gross margins?
I'm sorry, I didn't understand your question. Could you please repeat?
No, so the first part of the question was, is it fair to say that the Bangladesh sourcing advantage is to the extent of 15%, given that imports from China have an anti-dumping duty?
Yeah, so there is an advantage of producing in Bangladesh compared to importing from China. And more than the number, I think, what is the lead? Sorry, Nico, you were saying something.
Yeah, 15% is right.
Yeah, so yes, so the answer to that question is yes. What is your next question?
Yeah, so the related question is that as we answered to the previous question that we will be chasing market share. So this sourcing advantage from Bangladesh can clearly make us more cost competitive, and hence in our journey to gain market share, we may not have to compromise a lot on our gross margins. This is what I was trying to understand. Is that assessment correct?
Yes, we would continue to have that advantage, while I'm sure competition can also catch up looking at other lower cost of manufacturing basis. So that is definitely a room that we have to play either on the market share or spend on consumers or look at having a better margin profile. But that's going to be completely dependent on in that situation, and the strategy therefore will evolve basis what is the market context at that point of time.
And lastly, sir, given that a lot of unorganized players operate in the luggage industry, would it be fair to say that the organized players would have gained retail market share in the stores? In FY21?
Too early to say. It's too early to say that, because only once things normalizes in the market completely is when we will get a sense of that. But a situation like this does pose a bit of a problem to the unorganized sector, who relies on their own imports or getting imports through merchant importers and all that. But As we speak today, this is conceptual, and therefore we need to see once things normalizes how the market dynamics is evolving.
Sure. Thanks a lot for your comments and all the very best.
Thank you.
Thank you. The next question is from the line of Suman Kumar from Motilal Oswal. Please go ahead.
Yeah, hi. So, can you talk about sales mix of urban, semi-urban, and rural currently and versus pre-pandemic?
We can talk about how various channels are evolving, but and within that there are insights about from the e-commerce channel that the tier 2, tier 3 cities within e-commerce seem to be showing a better traction. But really speaking, I won't be able to throw light to you for between an urban and a rural contrast between COVID and pre-COVID and post-COVID.
So can you talk about the growth momentum in the two markets?
Sorry, I didn't get your question. Growth momentum on?
So you can talk about the growth momentum in the rural and urban markets, urban and semi markets.
Okay, as I said, it seems like post-COVID in the revival phase, the tier 2, tier 3 cities, and it's not rural and urban, but smaller cities to larger cities. Smaller cities seems to be reviving slightly better than the larger cities in terms of our category revival.
Okay. And talking about the wedding segment, we have a better expectation, but during month of May and April there was a lockdown. So the overall demand impact, whatever demand we were expecting, it has a significant impact or some the partial impact.
In which segment? Sorry, I didn't get you.
A wedding segment I'm talking about.
Sorry, which segment actually?
Wedding. Wedding.
Wedding segment. Okay. I was thinking about it. So yes, in April, May, including the wedding segment as well had the impact quite obviously because with the lockdown like last year, possibly either the dates were changed or the level of celebration was significantly muted. So we did not see anywhere close to the normal wedding season that happens in April, May, June.
Thank you so much.
Thank you. The next question is from the line of Digant Haria from Green Edge Wealth. Please go ahead.
Hi, so my question is mainly that, I understand that pandemic has, been very harsh on luggage, travel, cinemas, all these industries. But if we just look at our portfolio of, polycarbonate duffels, backpacks, these Capri, the ladies' purse brand, and across all the channels, like have we been able to maintain our position more or less in, these products as well as these channels, or we have seen some change in our competitive position across any of these matrices?
Are you talking about competitive positions within the categories and segments?
Yes. So I just want to know that our brand strength or our positioning. Has it been impacted? Like, has any player done something really different that they've taken up some segment by surprise or some market share? If any insights that you can give generally on these things, that would be great.
So I don't see anybody within this industry that we are in has done something very, very different or dramatic. I think everybody has kind of been reeling under the impact and managing their businesses. There has been a little bit of changes within channels and all that with direct competition depending on which channels are more active for a particular competition. So for example, channels like CSD or an institution business or to that extent e-commerce has done significantly better in the last 12 months, let's say from till March, than other channels or in other years. And any player who was more who had a higher index on those channels has possibly got a little bit of advantage. But that I would say a little bit, and that is temporary because as things comes back to its normalcy, the channel plays will also get reset back to what it was. There will be a bit of e-commerce which will scale up permanently compared to other channels, and we recognize that, and we are completely on top of it now in terms of our play into the e-commerce channel.
Right. So my other two questions are mostly data questions that I think you answered it for some participant that if our demand goes back to pre-COVID levels, would 15% of our soft luggage sourcing happen from Bangladesh? Like, can Bangladesh, have 15% of the total soft luggage manufacturing there, or?
Yeah. So you're saying if when the demand goes back to its normal level, will we have enough capacity to supply from Bangladesh?
No, sir. I was trying to get at that earlier, like 70% of our sales was soft luggage, and all of it used to come from China. So now, with Bangladesh capacity and what the work that we have done there, once the demand comes back, what could be the Bangladesh's contribution in our whole soft luggage portfolio?
It will be able to manufacture the entirety of the demand, because we are also eyeing as the demand goes up. One, we have already created huge capacities, and we are also good at creating, and we are fine at creating more capacities in Bangladesh if the demand so increases.
Okay. So, sir, you are saying that China may actually, China may just be, the dependency on China will be completely reduced once things normalize, and that could be a source of better margins.
You're right. In the long run, we will reduce our dependence to a very large extent on China imports.
Right. Perfect, sir. That's great to know. And the last question is that we have around 200 crores of debt. I know that we have taken it just as a prudential measure and never used that. But when do you think would be the right time to repay it? Would it be when we receive the insurance money? Would it be when the second wave is resolutely behind us? Any thoughts on that would be helpful. Thank you, sir.
I'll take that question. So current debt is 150 crore and not 200. And these are NCD which are maturing, one in July and one in September. We will be repaying this because whatever daily needs we have, we can do it through our normal working capital route. So these NCDs will be repaid in July and September. When it is
All right. Thank you so much. That's it from my side.
Thank you. The next question is from the line of Aditya Malpani from Bryanston. Please go ahead.
Hi, sir. Sir, continuing with the last China-Bangladesh question. So our understanding is the kind of variety and the kind of SKU China can make. Do you think it is possible in such a scenario, it is possible to shift that entire sourcing from China to Bangladesh? I mean, is Bangladesh competitive enough in terms of, say, SKUs and variety compared to China?
Yeah, your question is Bangladesh technically capable enough to make all the products? The answer is yes.
Okay, so it is practically possible to shift everything from China to Bangladesh.
That's right.
Okay. And so my second question is, because of COVID in the last 2 quarters, we have seen downtrading happening, and value portfolios and the value products are doing much better than premium products. So, by any chance, has it helped smaller and unorganized players to gain the market share instead of adversely impacting them because of COVID situation?
Temporarily, possibly, in terms of, because if they were already playing this game better and they had the stocks and the range, but that is, as I said, very temporary, and we would always follow the demand, and having followed the demand, we've kind of done what we need to do to go after the consumer and the consumer change, that the demand change that has happened in the short term.
Mm-hmm. Okay. Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Jinal Sheikh from Avriga Capital Advisors. Please go ahead.
Good evening. On your profitability margins, FY20 obviously was the high numbers. By when do you think over the next 3 to 4 years we can achieve those numbers or even surpass, considering what you mentioned about Bangladesh?
Well, as I said, this is at this point of time predicting, doing much, any prediction gets very, very difficult. And therefore, we are more focused on building the fundamentals, keeping our foundation strong. And as situation revives completely to what it used to be before, I think that's when it will start, hitting the similar numbers and scaling beyond that. Don't see that happening this year for sure because Q1 is our largest quarter and we've had a big hit once again this quarter in Q1. But it's for us to wait and see how things, revive from here and then see how this year will be and possibly the coming year, FY23. If all goes well, I'll be keeping our fingers crossed. FY23 could be the year.
Okay, thanks. And just our next question is on the market share. Just trying to understand that if in the last, have we lost market share in the last year or two from competition?
Yes, we have lost market share in the last 2 years.
And based on what you said earlier, that once things come back to normalcy, you would want to focus to get that back, right?
Absolutely.
Okay, thank you.
Thank you. The next question is from the line of Sanjay Banerjee from Prudent Capital. Please go ahead. Mr. Banerjee, your line is unmuted. Please go ahead with the question.
Hello. Hi, sir. I just only one question. Sir, what is the current tax rate for importing from China and from Bangladesh?
Neetu, would you like to take
it? From Bangladesh, there is no duty. Right? We are talking about import duty. Whereas
yes.
From China, it is 15%.
It is?
15%.
Okay, thank you.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, couple of follow-ups. So what would be online contribution for FY21 and RCD?
You are saying the e-commerce business, right?
E-commerce, yeah.
So FY21 saw almost 17% of the sale coming from e-commerce.
Okay. So is the gross margin contraction reflection of that change as well? Because typically consumer on that channel is much more value seeking than on offline.
The expenses, the cost of selling in e-commerce is, other than the margin, is not very high in terms of the fixed costs or overheads. Unlike what is there in retail or in modern trade with promoters and all that. To some extent, the higher, margin on the channel kind of gets nullified with the lower overheads to sell on the channel. Having said that, right now the mix that is selling in e-commerce as the scale up happens is of the lower priced variants or lower priced products. So to that extent, it has an impact on gross margin. But I would say that's now, and over a longer period of time, consumers will kind of start. We will have all kind of consumers in e-commerce, and the margin and the mix will improve.
Sure. Second, this wave has come with as much surprise as the first wave. Obviously, this time our cost structure is much more agile. But on planning part, because just 2 months back or 3 months back when we were on the last call, we were very excited and rightly so about the revival and then first quarter being very good. So have we pre-invested in terms of inventory or other commitments which may hit P&L but revenue growth may not follow because of the wave 2?
So we did expect a much better Q1, when we were planning for it. However, if at all there is a reflection of that in inventories, it is more in raw material than in finished goods. We did build some stock in terms of our own manufacturing from Bangladesh, but as of today, we're not very worried about the inventory levels that we have.
And lastly, Mr. Anja, this question is specifically for you. So you have taken charge on this at a very difficult time, and that was the case for Ms. Neetu also last year. And then as they say that one should not let good crisis go waste. So are you seeing an opportunity to make any structural change in the business, which whenever the normalcy comes in, and that is a matter of speculation, but whenever it comes point to point, VIP is much more stronger and much more agile unit than it is today?
Yes, and I think we were already on to that path, and I may add a few more. But as I was saying, that fundamentals of the business, which is our control on our upstream, our manufacturing of our own long-term advantage on cost, we have made ourselves far more leaner. We are looking at revamping our whole supply chain structure and the method of how do we optimize our inventories. So there are many initiatives that were on, and many are getting built as we speak, which kind of tries and attempts making the fundamentals stronger. Therefore, as we come out of this, we would be in a far better situation to leverage the opportunity, and that's the aim of the management.
Great. This was very helpful. Thanks and all the best.
Thank you. The next question is from the line of Prerna Jhunjhunwala from B&K Securities. Please go ahead.
Thank you for the opportunity. So I wanted some clarity on your OEM part of the business that we were thinking about supplying to global markets from our Bangladesh unit. What is your strategy there, and what is the kind of opportunity that you're looking at from that portion of the business?
So, to be honest, we don't have much to talk about it in this forum today right now. That's a possibility, definite possibility. We do have good manufacturing strength and the right kind of cost to look at that business. But this is not something that we have done in the past, and this is not something that we are ready to talk right now. Let's see how we evolve. And large part of that whole manufacturing base that we had created was for the India demand or the domestic demand that we have. So we really have to think through in terms of how do we, use that opportunity, whether it's for OEM or kind of look at the demand here. But we could talk more about this in couple of quarters down the line, possibly.
Okay. And any color on the international markets that you serve from this unit for your own brand, your export business largely? Because exports have been doing very well in other industries per se.
No, unfortunately, COVID has obviously hit across the world and it has impacted travel. So it's not that the luggage industry is in buoyancy in any part of the world. But having said that, other countries are possibly reviving better and faster than India right now, especially the Western world. And we do have a good setup in Middle East, and as the lockdowns are opening up there, things are coming back to normalcy. Our business should grow in the Middle East. But as we speak right now, it's a much smaller part of the overall business, and it's not something that we are putting as our priority one to at this stage to look at and invest in international markets.
Okay. And so my next question is on the channel mix per se. Like, how has been the sales throughput in canteen store departments and distribution network for the year, MBO channel? If you could give some color on how the year has panned out for you in different sales channels, it will be very helpful.
So, every channel had its share of the pandemic impact and differently so. And out of that, I was saying before that possibly CSD and institutional business had the least constraint because they were not moving through the marketplace, or in people were not needing to go out for that. So to that extent, CSD, institutional kind of business and e-commerce had a much better play than the traditional channels of modern trade, general trade, our own retail. So that's the change that we saw during the year compared to the previous year, that these channels kind of indexed higher or their salience grew within that overall portfolio.
Okay. And how would you see the inventory in the supply chain today with respect to your channels? if there is a pent-up demand, are they adequately filled for the demand, or it will require, there will be some challenges on that front as well?
No, as I was saying in the previous question, that since we are now manufacturing in Bangladesh, we should be able to feed the demand in a shorter term notice compared to what we would do otherwise from import. So we feel good about how we are placed as far as when the demand opens up, we'll be able to scale up.
Okay. And last question on capex: is there any capex planned for enhancing the capacities or upgrading systems or anywhere else for this year? And what was the capex, if at all?
Nothing major at this point of time. But if at all, it will be only in the second half, and that too 15 to 20 crores.
Okay, that will be on enhancing capacity?
Yeah, enhancing capacity.
Okay.
Predominantly advanced.
Okay. Oh. Thank you so much, sir. And all the best for the year.
Thank you.
Thank you. The next question is from the line of Samir Raj from Nippon Asset Management. Please go ahead.
Yeah, good evening, sir. Sir, I just wanted to ask you, since this is your first call, kind of, so, from an outsider's perspective, if you were to look at VIP and if you were to do SWOT analysis, which are strength, weakness, and opportunities in the company, and when post-COVID things come back to normalcy, what kind of changes would you want to bring in this company?
You're saying that, once situation normalizes, what kind of changes?
Yeah, so, if you were to analyze, I'm sure would have analyzed this company, so would identify which are the strengths, which are the weaknesses, and how do you want to reposition this company so as, it creates value for all the stakeholders?
Yeah. No, I think there will be many areas on which we are going to, scale up and build strength, but I don't think there is one answer to that. It's a full-fledged strategy discussion, but largely I think what we are doing in this time as the pandemic hit is that we are strengthening the foundations of the business, which is in the consumer part of the business, which is product, process of innovation, looking at cost, capability for manufacturing. So all these areas are going to be something that we'll work on. But right now there is nothing that I can tell you about what will be the big different changes that will happen. These are things that we are working on right now, and we'll see when we come to that in terms of if you look at other businesses that we will get into.
Sure, sir. Thanks for answering my question.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Ms. Neetu Kashiramka for closing comments.
Thanks everyone for taking out time and attending the call. We hope that the country opens soon and we do well. That's the hope in which I think we'll end this call here. And in case you have any other question, you can anytime connect with me. Thank you. Thanks a lot.
Thank you. Thank you, everyone.
Thank you.
Thank you. On behalf of VIP Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.